on the CKNW Morning News. Danielle Park with us now, financial analyst, portfolio manager, president of Venable Park Investment Council, broadcaster and author, and we are wanting to know if we have any lessons that we've learned or not from what happened in the United States as far as Canadian investors are concerned. Danielle, thanks for being back with us. Any lessons here?
You know, Phil, I don't think that's really the message we should take from this. I think what I was saying before this budget deal was reached is that I expected them to come to a last-minute deal of some kind, and I think that they will continue to manage by crisis as we go forward here for a while. So there's no doubt that it had a cost to the American economy, the 16-day shutdown. What's really important, though, is that the growth was already weak before this happened, and I think this is the thing, the investment risk when people are looking at how to allocate their money right now is that stocks are overvalued relative to what the growth in the world is really looking like. And I felt that way strongly before this shutdown, and the shutdown simply taken something like 0.6 off of GDP that was already less than 2. So why that matters to Canadians is that if you look at our economy, we are still very dependent on how much the U.S. buys from us, and also our energy, minings, and material sector are really the engine that drives much of the GDP growth in Canada. And those things have been in contraction now since 2011. So really what's been keeping our financial markets buoyant in the last little while has been the spin-off hope from QE, that QE would, be a savior and support the economy, and we're just not seeing that. We're continuing to see a downdraft in world demand. So I think that the problem here is not about the U.S. government. That's been a problem for years. The problem is that the world's in a downtrend of growth, and that too many people are holding stocks right now that are very overvalued. So I think that the risk is that you continue to hold that thinking, oh, well, they reached a deal, no problem, but that's really missing the point. And I just want people to be careful that they're not overexposed based on, superstitious beliefs in things like QE or a debt deal, when that's really not the main show. The main show is valuation and growth. And we've seen that overnight with eBay and IBM and Goldman Sachs. All of these companies are reporting big misses to their revenue numbers. That means sales are weak in the world. The retailers are all warning. People aren't buying consumer goods like they were. That's really what people have to think about right now.
Well, and I'm going to get you to stand by because I want to come back with a very simple question for you. I don't know if there's an easy answer. How do you protect yourself? You're protecting your investments, protecting your financial future. We'll carry on with Danielle Park momentarily here on CKNW. 8 degrees outside Pacific Center. We get back to Danielle Park, financial analyst, portfolio manager. We're talking about the deal that they've reached in the United States, but the bigger question that I think a lot of people have, Danielle, people feel kind of helpless. That you go and get your RSPs, you pay into your mutual funds, and you sort of hope for the best.
Yeah, and unfortunately they're not very good investment products for people to use because they're very expensive. They have a lot of internal fees, and they expose them to a market cycle. And the market cycle is really what drives the return. So if you're paying to be exposed to a market cycle that's weak and unrewarding, and you're paying a few percent in fees, you really are getting nowhere. You're getting risk with very little to no return. So it's very difficult to be in that kind of traditional product in this environment. I think people have to depend less on hope and dreams in this kind of thing and really think about their capital. And that means preservation of capital. And I know everyone's desperate to make income because rates are low, but we're waiting for the full market cycle to complete here. We had a low last in 2009. We've had an expansion of fits and starts since then. And now we're looking at the next downturn coming. So that means you need to be very limited in your exposure to equities because, as I said, if equities are the thing that's the most overvalued, and in particular in Canada, Phil, it's financials, utilities, and REITs, the things that everybody has run to, as the commodities, mining, and energy sector collapsed back to the '09 lows over the last year. You've seen that everybody sort of ran for the dividend-paying stuff. That's where the greatest biggest price risk is today. So I don't want people to cling to dividend-paying stuff that's giving them 3%, 2 or 3% of income while they lose big chunks of their capital, just as they did in 2008. And I think the way to do that is to say, listen, business cycle's been expanding off the '09 bottom. We're due for the next downturn. It's better to take capital off the table, park it to the side in things like short-term GICs and investment savings cash accounts. Yes, low yielding, but protect the capital. That's the main focus here, because the good news is that if we can get through this next down leg without losing chunks of capital, we will have the opportunity to buy those things back at much lower valuations. That means higher yields with a lot less risk. And it is possible to do that, but you can't just stay on the train, indefinitely without getting off first. Otherwise, you can't buy back in at lower levels.
Danielle, thank you for joining us again. Nice to talk to you.
Thank you, sir.
Bye-bye now. Danielle Park there with her viewpoint, and we'll have more discussion about this, investing and the impact and the reaction to what has been happening in the United States and, of course, the fallout for this country and investors here. CKNW.